Okay, so let's go back into it. We had the high of the week form on Wednesday. Well, that's right out of the free tutorials, as you would expect. All right, so let's go back into the chart here. We're looking at the Wednesday high. So this is high of the week. The market trades down. It reaches into that weekly liquidity pool. It does so here. Rallies away, trades one more time, creates a double bottom. Comes all the way back up to at least the equilibrium price point of the weekly high, from this high to the new low. Trades back up to midpoint of that. Why does it do that? IPTA does that to pick up more orders and allow fair value entries on the banks. The market trades down lower, comes back up, rebalances, and then drifts, and then makes an aggressive run down to make the low of the week. Here's our 10, 20, and 30 pip grade swings below that weekly liquidity pool. So everything here, if we zoom in, $10 pip right here, 20 pip right here, 30 pip here. Just fell short of it. It's like 29 pips or whatever it was. Didn't quite get down to 30. But it gives you a nice rule-based idea every time we look for a run on liquidity. So when we have these theories, okay, when we're looking for price action to do specific things relative to that daily time frame, we incorporate the daily time of day and the kill zones to formulate ideas when liquidity will be rated, okay, when the stop runs occur. All of the things that cause the market structure theories, like we have these double bottoms, which is what we call on the Twitter feed Candyland, they don't like to leave price action like that. So we're going to anticipate this whole run here. If we know that that same fractal that's being shown here works on a 15-minute time frame, and it works on a 1-minute chart, a 5-minute chart, why won't it work on a daily? Absolutely will work on a daily. In fact, it's going to work more often on the daily than it will on any other time frame. Why? Because the interbank is based on what that chart's showing. It's going to give you the truest form of knowing where the market's going to go, the most sensitive price points on the highs and the lows, where there's fair value, where there's inefficiencies, and where there's buy-side and sell-side liquidity. Everything you're looking for is derived from that daily chart, because you can still pick up the insights that would be seen on a weekly chart by studying a daily chart if you know what you're looking at. Now, don't read too much into that and say, send me emails or ask me on Twitter, what did you mean by that? You learn all that in the mentorship and beyond charter level. It's important for you to stick to one narrative. That means seeking liquidity outside of the candles. Now, what I just told you is what I hint at all the time on Twitter. But the uninitiated, they have no idea what I'm saying. I'm looking at what's outside of the candles. That's the liquidity. In this case here, it's the sell-side liquidity pool. There's nothing down here that's being seen in retail's mindset in terms of what they see on their chart. They see that as support. I don't. I see that as liquidity, and it's outside of the chart. Think about it. You look at, as a retail trader, support, resistance, trend lines, moving averages, indicators. They're all very interesting. They're entertaining, but they rarely work. I look at things that aren't necessarily seen in price. I show you where fair value gaps are. I show you where inefficiencies exist. Buy-side inefficiency, sell-side inefficiency, buy-side imbalance, sell-side imbalance. I show you and tell you what the narrative is that creates those things and why the market will reach back to it and what it should do once it gets there. All of that is outside of the understanding of a chart from a retail perspective. That's why you, as my students, are learning how to do what 99% of everyone else around the world cannot do. predict price. We do it every single week based on what we do on that daily chart. That's the secret weapon for bias. If you do not use that daily chart, you're going to struggle with your bias. It's just as simple as that. So if we go back and we look at that idea of when the market is seeking that higher time frame draw on liquidity, which is again is that weekly liquidity pool, from Wednesday down to here, we're above that opening price. So all up in here, we're close to, if not at, the very high of the week. Why would I say that? Well, we have equal highs in here. We have a high and a low, so there's a range in there. So if we just look for simple optimal trade entries, go back to baby pip days, low to high, we're basically at the sweet spot, creating the high of the week. So everything I was giving you on baby pips still works, but you need to know how to use those things I taught on baby pips. Once you understand mentorship level, you can go in there and pull out Trader's Trinity, things I don't talk about anymore, and you can literally look like a wizard to the retail world, because you'll be able to do things with price action that no one else is able to do, because they're looking at patterns for pattern's sake. They're looking at Elliott wave and trying to decipher what's the count, what wave are we on, what ratio should I have if I'm a ratio trader, what harmonic pattern is harmonic right now. Okay, it's, look, anybody that's interested in harmony, okay, in what they're doing, use eHarmony, okay, and no, they're not a sponsor. That's the only harmony you need to have as an individual, okay? Because if you try to incorporate harmony in price action, you know, you're going to find that you are going to struggle. You're going to find that you're trying to force things. You're trying to look for things, okay? Instead of saying, what is price most likely trying to do here? It's going after the money. Whose money? Large funds. It's just that simple. It's just that simple. That's why COT works. COT data, Commitment Traders Reports. What is that? It's showing you the relationship between the large pools of liquidity being held by the large funds. Who gave those positions to them? The counterparty is the commercials, the large institutions, the banks, the producers or manufacturers of that market or commodity. Since the currencies are a commodity, we understand that the relationship for price delivery is not based on the retail universe. Retail is too small. It's too insignificant of an animal that doesn't leave a mark. It just can't, it doesn't support it. But large funds, okay, large funds are the market. They are the buyers and sellers. The liquidity providers are the commercials. So we look for the relationships between those two parties in price action, and where their stop loss would be, that's where the market's going to go. Where a return to a level that would not necessarily be seen as bullish for a large fund trader, the commercials would see that retracement lower to fill in some fair value and then pick up more orders and then go higher and move against the intermediate term swing low and high that would be against the large fund's position. And you'll understand what that means later on in mentorship, because I'll teach you specifics on how to find it in price action, real accumulation, real distribution. And you can measure that with tools that I'll show you using price action. But when we look at the weekly analysis videos, it's important that you go with